We should be live, huh? No, wait, wait. Don't accept yet. Yeah, accept now. Yeah.
Hello everyone. Hope everyone is having a lovely afternoon. By the sounds of things, we're all in different regions of the world. So yeah, I'm pretty sure the weathers are different everywhere. But in Cape Town, we're having a lovely sunny day. It's a bit hot. But yeah, I just wanted to welcome everyone to the State of Tech in Africa. Um, First of all, my name is Mandilake. I'm the Marcoms League at AfricArena, and I'll be your MC for today. I just want to quickly introduce everything, and then Dan will take away right now with the start by presenting us the video for Africa Arena's Grand Summit last year. Okay, Dan, you can take away quickly. Thank you.
Thanks, Randy, and welcome everyone. Welcome. Thank you so much for joining the State of Tech in Africa 2026. It's really a pleasure to have you. Today we have a great program. We have amazing speakers with us, and we're going to really impact what happened 2025 in the African tech ecosystem. So without any further ado, the first thing that I'm just going to do, I know that we are here to hear from the speakers, but just before, I just want to give you a quick introduction again to AfricArena for those who are not yet familiar with us. I see a lot of our friends also connected. Welcome again. And just a brief about AfricArena. So we are a platform that is focused on connecting startups with investors, with a primary focus, attracting capital to African talents. The way we do that, I'm going to show it in a moment, is that we do it through a tour that we do across the continent and even outside to be able to bridge African tech ecosystems together. So you're going to see later in the presentation, you have the various parts of Africa with different numbers. So you want to really bridge that gap, connect the ecosystem together and bring to the world the African talent in the eyes of everyone. So just a brief about our story. So we started since 2017, and we are proud to say that since then, when you look at in January now 2026, the startups that have participated, that came through AfricArena, directly and indirectly, that we connected to various investors, we have an alumni pipeline that raised about $953 million. And we hope that this year we're going to reach the $1 billion. So you have about 500 plus startups that directly pitch and 1,000 plus startups that indirectly or directly join. And we also have a lot of programs with corporates. We partner with various players in the ecosystem, in the likes of AWS and so on, to do one thing, bring, as I said, the African talent to the world. And on top of it, we also have a large network of investors in our network through our group that is called Digital Collective Africa, that we also have the occasion to speak about. And that's where we operate and we fuel the stars that we have participating in our tour. So just a brief, AfricArena is really a large ecosystem that is composed of Africa Rise, which is our accelerator program. And we have, at the end of the year, each end of the year, a grand final that we call the Grand Summit. And our goal is to have inside those program various sub-events, because AfricArena at the end of the day is not just a conference, it's a program. So we have various activities such as Founders Retreats, World Connect, which is our B2B Connect event where we have startup and investors meeting. We also organize learning expedition in the cities where we go. And on top of it, at the end of these sub-events, at each of the tour that we go to, we have 1 or 2 day summit where we showcase these startups as well as have this network coming in together. So just a quick brief about our calendar this year. So many of you have been asking, okay, what's the program this year? Where's AfricArena going? So in just a month time, we will be in Kinshasa. Then afterwards, we'll be in Nairobi from the 29th to the 30th of April, alongside the Africa conference. Then we are going to be in Senegal. And on top of it, we're also going to focus on a tour in Europe. We're going to be in Amsterdam. We're planning to be in Amsterdam, potentially alongside Vivatech, and organizing an Asian tour around July. The date will be confirmed in Seoul and Tokyo. And then just to add, in September, October, for those interested, we are going to be in Cairo, Egypt, to have our second half of the year finalized by the Cape Town Grand Summit, which happen every year around the same time during the Investor Week. Now, just a brief, AfricArena Kinshasa Summit is up. The link is on the website, as well as the Nairobi Summit. Please go on our website, africarena.com. You will find all the information. And if you want to join us, don't hesitate, connect, check our website. You can even contact us, and we're going to give you all the information on how to participate, how to join, and the details about our program. And just a quick brief, Digital Collective Africa, there is a website as well. You will find a lot of very, very insightful resources that are made available to the public from our community, just to help, especially founders, with knowledge-based practices for fundraising. So we have different various work groups that are animated by our network of investors. And on top of it, we also have an app, AfricArena Wired, which is constantly being updated with our network of startups through our portal. So I encourage you during this call, I'm going to share the link after I presented on the chat. You are welcome to see more. You're welcome to download. And on there, you'll be able to find out our previous events, our previous presentation, and everything that you need to learn more about AfricArena. So there's a QR code on the screen. You can scan it. This is where you'll have most of the information that I shared about, all the links in one, because I know I've shared a lot of resources all at once. But you're really welcome to get to know more about us and engage with us. So thank you very much. This is the first part. I'm gonna pass over back to you, Mandy, so that you can take us to the next step. I know that I'm jumping just now.
Okay, great. Thank you, Dan. Like you said, yeah, that was quite a few resources that are actually very useful. And if you didn't manage to get all of them, don't worry. We will be resending most of the links with our newsletter after the call. So if you're not subscribed to the AfricArena newsletter, please just drop your email on the chat and I will make sure that you will get subscribed and then you will receive all the information that Dan mentioned. Great. All right. So moving on to the next section, we will be diving into a bit of conversation between Samuel and speakers, but I don't want to mention a lot. I will just let Samuel actually take over that and mention who are the speakers and what is the discussion basically about. All right. I'll pass it back to Samuel.
Okay, so before that, Mandy, no, thank you so much for almost introducing the panel. Samuel, you just give me 5 minutes. Just before that, I'm just going to be briefly speaking about the report itself before we get into the main conversation. And just to give you a bit of history, since 2020, we have been working on the report State of Tech in Africa with really one primary goal, is to impact the stories behind the numbers. So we are seeing all these numbers coming up online. There has been so much fundraising and so on. This is what the data are saying. But then what are the stories behind it? What are the startups? How are the startups doing really in the ecosystem? So we impact that every year. And we are proud to have our 7th edition this year. And I'm going to present to you very, very briefly what we have been speaking about in this report. So first of all, we look at the numbers. You will be able to download it just after the conversation with Samuel and the speakers. But the first thing that you would have seen, it's coming from different sources. We focus on our side primarily on Partech because of the undisclosed deals that they brought in their report. But over and above, every report and every indication are now green for the African ecosystem since the past, I would say, 2 years. So we are seeing now an increase in terms of the fundraising. And on top of it, just to give a bit of the breakdown of the numbers, we have seen that debt is coming now more and more towards equity. So it's becoming more and more frequent. And that has been the one thing that has influenced a lot the numbers positively this year. So there's that traction that is coming in the investor side to say, okay, equity is still stagnant, but there's more debt vehicles that are being available for the African tech startups. So these are some of the signs that we have seen that explain that incline. Now, just to speak about the differences, of course, we are trying to analyze. We have here Max from the Big Deal. Maybe we speak a bit more about that. We try to understand the definitions between the different resources that are available to us. But you have three resources in your hands when it comes to the data that are being impacted. Africa, the Big Deal, Brighter Bridges, Partech, with different definitions that you're going to be able to understand in the report, just so that you're not confused in what do I take? Is it 4.1? Is it 3.2? It really depends on the approach, on the geography focus, and so on. So we have been really privileged to analyze that, to unpack that, but it's not the most important. The most important is to see this positive sign coming in the ecosystem. So one thing about just the Big Four, nothing has really changed since last year and the previous years. The Big Four is still dominant in the African continent there is about 80% of the funding that went to only 4 countries. It's coming again. We can see the similar number coming again this year. But one thing that we saw that was particular, and we just try to give a bit more attention to that, is on the Francophone African side. You'll be able to see it when you read the reports. There is more, we can see a bit more movement, and VCs are more attracted to countries like Morocco, Senegal, and so on, even though much of the funding is going to fewer startups that are really demonstrating traction. Now, one number that we tracked, but that is still that we saw a bit of incline, but still a lot of work to do, is the equity going to female founders, female-led startups. We saw a bit of incline, but still a lot more to do on that side. We are hoping through Digital Collective Africa to also bring that initiative through our network of investors and pushing that diversity in terms of the funding to be more balanced. But we have remarked that there's still work to do on that side of the funding. And just a view about AfricArena versus global when it comes to the fundraising, we are still less than 1% of the share of the global equity funding in 2026. All the numbers are not yet fully out, but still, when you compare some of the cities in the US, like Miami, all the funding from all the south from Africa equals the funding in some of the cities in the US. And I'm not even going to compare it to Silicon Valley. So that shows the contrast of us against the world, if I can see, if I can quote it this way. But we are hoping to see a surge. We are building the ecosystem. We are pushing to attract more and more investors so that there can be more and more development on the continent. And just quick brief from our friends from the big deal. Look at the numbers of the exit. There has been some positive news since the past 2 years. There's been about 42 exits that has been disclosed with an amount of about 290 million, but still work to do on that side, especially on the IPO, which remains very low. So without any further ado, I'm gonna pass it briefly to Christophe. He's gonna speak more about the predictions. And then from there, we are going to jump straight into the main conversation. I think, Christophe, mic is yours.
Hey guys, Happy New Year and welcome everyone. So it's an exciting moment for us when we launch this report, as Dan said, the 7th edition. If we look at 2025, looking back 1 year ago, things looked pretty dire when the new US administration shut down programs like USAID. We were just really at the tail end of the winter in the VC space, both globally and in Africa. And that really started with the really bad news. So if you look at the prediction we had for this year, we actually had predicted $4 to $5.2 billion in investment in January 2025, looking at a number of factors, including the new US administration. And we landed up pretty close to the actual, which was 4.1. If we look at 2026 now, we believe that we're going to continue to see a valuation normalization, which we've observed through the last 2 years, particularly in fintech. So you see more sustainable level of valuation, better risk-adjusted return for the investors, and that's laying the groundwork for a renewed cycle of investment, exits, and essentially an upwards trend. We can see that there is a much more selective approach of international capital, international VCs, of course, but also on the LP side, very much looking with a lot of care of where they're putting their capital allocation. So we see a rise in inbound investment from the MENA region into Africa. We also foresee increasing interest from the East. So we were in Japan in December for our last event. You might have seen Novastar announcing a close with about $18 million of LP from Japan. So it's a market we've been observing for a long time. We see that this is going to accelerate, and it's actually largely driven by corporate, which is interesting, but lots of selective approach on the international capital. So we don't foresee that the investment is gonna see a tremendous growth in 2026, but we see a sustainable growth in 2026. There has been a lot of hype on the AI in the last 2 years, where a lot of investment have taken place. So it's been slow in Africa. And I think we're going to continue to see, we haven't really seen a crazy hype like we've seen in other markets. I think that maybe there'll be a leapfrog effect here with some interesting early stage AI startup with clear path to revenue, particularly in areas of healthcare, agriculture, and financial inclusion that are going to deliver some great rounds of fundraising and potentially some exit. We saw one IPO in 2025, so let it be a good omen for this to continue. If we look at the next slides, elements that will probably provide a boost to 2026 we see a lot of potential in stablecoin adoption. Actually, some countries like Kenya and South Africa have moved aggressively in reforming their policy in this regard. So we think that there's going to be a lot of startups raising capital in that segment, in the fintech space. I think fintech is going to be interesting in 2026. We're seeing some consolidation, but we're also seeing new capital coming into the space on the back of stablecoin startups that are disrupting the space. The second element is we've seen a lot of exits in 2025. Actually, the number of exits has doubled compared to 2024. When you see an increase in exit, we see very quickly the capital being recycled the following year into new ventures. For example, last year in 2024, we had the exit of Quickhead in South Africa. That immediately translated in reinvestment. The founders creating a new fintech company the following year and raising a few $1 million. So the capital tends to recycle fairly quickly, especially on the founder side into new projects, and that has a snowball effect. So last year we had exits like the NetBank acquisition of iCoca, for example, $100 million. This capital is going to recycle. It was served to the likes of CrossFin and the likes of the founding teams. So you can expect that this capital is going to be recycled into 2026. So that is going to have a booster effect. The $670 million of exit we had in 2025, large chunk of it probably is going to go into back into the ecosystem this year and the next. The debt revenue-based financing, which has been growing steadily. In fact, it is the booster in the ecosystem at the moment. Equity is actually slightly decreasing. We see that that's going to continue to rise, primarily in fintech and climate tech, and this is good news. You have more new type of investors that are coming in there, and also it prevents founders making the mistake of using equity to fund working capital, which has been a really bad idea in a bunch of startups. So that's a really healthy sign. And long-term institutional capital is here, very slowly coming in. So the reform we see on pension funds, capital allocation, all the drive behind this, whether through Startup Acts or through the lobbying of AVCA or similar association, is bearing fruits. So we're starting to see it in countries like South Africa and Kenya, and we are very positive that that's going to produce long-term effect. So this, and if you go to the next slide, then combined to the capital that is coming out of exits, we believe it's going to have a positive effect. So our prediction here, or this exercise is interesting for us because we have this model we've been working on since 2019 that's been pretty accurate on the foreseeing what's happening. It's obviously always a factor with some uncertainties and a bit of luck, but the fact we were really in the range this year proves that the model is adequate. We see a significant growth this year, so we foresee 4.8 to 5.2 billion. That's a significant growth. So it's a slight acceleration from what we've seen last year, driven by debt, the impact of those exits, and those factors that I mentioned previously. The interesting element here is we see that there should be an acceleration of this. We believe that post 2026, there will be some return of some US institutional and corporate investment in Africa, in M&A or through public-led program, because it's going to become one of the key battlefield. And so we think that we're going to hit the 7 billion mark in the next 3 years. So that's really exciting. And that's what we're seeing at AfricArena. Obviously, that's our own prediction. And, the reality, we'll see what it unfolds. And now, to our debate and discussion with our great speakers.
Okay, thank you, Christophe, for that. Judging by just from what Dan and Christophe mentioned, even if you were someone who was not as exposed to the ecosystem, I think you actually get a viewpoint of what was going on in 2025. And you can just tell that it was a busy year. And judging by that, only seems like 2026 is going to be a very promising year. So just like Christophe mentioned, I've been excited for this panel. I even mentioned it before it's time. So yeah, today we're going to have Samuel, who's the editor at IT Web Africa, who's going to be moderating an exciting panel between Gregor, Oluwaduni, Ashim, Megs, and Laura. I don't want to take more of Samuel's time. I'm going to give it to you, Samuel. Just introduce yourself and go on. Thank you.
Thanks, Mandy, for the introduction. And Good day, everybody, and welcome to the launch of the State of Tech in Africa 26 report. Today's session is about this conversation with the leaders who are actively shaping this ecosystem. And we will also have time for audience questions. So please feel free to drop questions in the chat as we go. My name is Sam Mungaze. I'm the editor of IT Web Africa, one of the leading tech publications on the continent. We focus on business tech, and we have a relationship with the AfricArena for a while. I think we've been working together for the last 3 years. And today we are meeting new people. So I'll start with just introduce who is on the panel. Then they can, with 30 seconds, they can probably 30 seconds to a minute for them to introduce themselves. So the first one is Ashim from, then we have Max from The Big Deal. We have Laura, Renew Capital. We have Greg, Digital Africa, Olu from Google. So guys, briefly, can you introduce yourselves to our audience? We'll start with you, Ashim.
Thank you, Samuel, and hello, everyone. It's a pleasure to be here. Yes, my name is Ashim. I'm the managing partner at Octera Capital. We are an investor based out of Lagos, Nigeria, and we invest across venture capital, so into tech and tech-enabled startups. In Africa, we also invest across private credit and do that primarily in Nigeria. Pleasure to be here.
Okay, you're on mute, Samuel, but I guess you asked me to introduce myself. So hi, everyone. My name is Max. I'm a co-founder of Africa, The Big Deal. We're one of those sources of information on deal data on the continent. I'm doing this with Maxime, and both of us have also been operators in the ecosystem. Maxime is with Catalyst Fund, and I was for nearly a decade with GSMA, in particular with the Innovation Fund, for which we've provided non-dilutive capital to 100 startups on the continent. Very happy to be here.
Laura, you're up next.
Thank you. My name is Laura Davis, and I'll just start by quick thank you to the AfricArena team. Just love what you do across the continent, in particular in ecosystems that are a little bit less active, because I'm very excited about all the smaller ecosystems in addition to what's going on in the big ones. So I am co-CEO of Renew Capital, and we are a Pan-Africa venture capital firm that's currently in about 13 countries on the continent. Back to you, Samuel.
Thank you so much. Greg, up to you.
Hi, everyone. So I'm Greg, CEO of Digital Africa, and Digital Africa, we are a subsidiary of Proparco, the French TFI. And we invest from pre-seed stage across Africa, focusing beyond the big four, a bit like Renew, and happy to co-invest along with you sometimes. And yeah, we do 30 investment per year across Africa, tickets from 20K to 100 euros.
Thank you so much. And lastly, Olu.
Hi everyone, my name is Olu Aduni. You can call me Olu. I'm the Accelerator Portfolio Manager at Google for Startups. The Accelerator is a global accelerator that has supported over 1,700 startups in 80 countries, but specifically in Africa, we supported more than 150 startups. We support startups through our 3-month program. We also provide access to credits for some Google products, as well as mentoring and our investor network. Really excited to be here today. Thank you.
Thank you so much. Let's dive into it straight away. We'll start with you, Max. It looks like from what the report says, funding is back. And what's the story behind the rebound, and what changed in the investor behavior?
I mean, I'm sure the investors will have something to say about what changed in their behavior in 2025, but we'll get to that in a second. More seriously, funding is back, but it's a reality that's also outside of Africa. If you look at the global numbers, it's basically what happened in Africa this year was aligned with the global trend. funding was back in 2025, was higher than 2024 and higher than 2023 on the continent, but globally as well. To give you an idea, I think if you look at the CBE Insights number, it's close to $500 billion in equity that's been invested in startups in 2025 compared to, I think, around 300 billion in 2023 and in 2024. So again, Africa is doing great, but is also following and fueling global trends, which is great. And before looking at the investors, I will also say that obviously the startups also did the work here. You need investors to have investments, but also you need investable ventures. And I think they were here this year in 2025 when more capital was ready to get deployed. We have close to, according to our numbers, 500 ventures that raised at least $100,000, plus many more that raised below that amount, looking at Grégoire here. So yeah, it was a good year compared to 2 years of year-on-year decline, which was less of a good story, even though a lot of the work that paid off in 2025 was done in 2024, 2023, and before that.
Thank you so much. And still on that, as a follow-up, let's look at Patek, which has reported about 4.1 billion, then Brighter Bridges 3.8 billion. Africa's data still has some gaps and inconsistencies, right, on reporting. What is the minimum standards of ecosystem, the ecosystem needs, the African ecosystem?
I think it's healthy to have diverse sources of data. I think it's the case all over the world. You don't have one single source of truth, and it would actually be concerning if anyone pretended to be the single source of truth on funding in Africa or anywhere beyond. I don't think it's particularly productive to spend a lot of time on like trying to define what a round is, what a startup is, what an African startup is. And also, you won't get a consensus. You won't get a consensus at a continent level. You won't get a consensus across markets, across sectors, and so on. We internally obviously have our own debate sometimes with Maxime and Elodie about whether to count a deal or not. For instance, a lot of the time in the energy space, I feel like the frontier between what is a startup deal and what is an infrastructure deal can be a little bit blurry. But I'm sure Patek and Brighter have the similar kind of debates internally. They count things that we don't. We count things that they don't as well. And by the way, just to correct what was presented in the introduction, and there was a table about the 3 sources of data. We don't limit ourselves to public data. We also source confidential deals with investors regularly. So we will continue, in my opinion, to have multiple sources of data, especially as the market matures and grows. As it grows, it will also attract more players that will collect the data, analyze it in a different way, and I think that's healthy. What I think we need at the end of the day is just to hold people accountable to clarity on what they are counting and how. In our case, our data source is available in the easiest format in an Excel, and not only people know what we're counting, but if they disagree with certain choices that we make, they can remove them and run their own analysis, and we know quite a few people do that. Don't just rely on the reports that are out there, but do their own analysis based on like the countries where they're active, the sectors, and so on. So, yeah, I'm all for it. I'm all for multiple sources of data.
And what are your projections for this year? What do you think will happen?
I'm optimistic there will continue to be growth because it was a good trajectory in 2025, and also because of the number of instruments available to startups that keeps growing and being more and more refined and so on. That helps. I mean, one of the reasons maybe why we didn't get growth in 2023 and to a lesser extent in 2024 is because the offering and the leverage of that offer on the debt side, for instance, was just getting built. Now there's a level of maturity. In my opinion, now if a startup wants to raise money, the options that are available to them are much wider, which will make it likelier for them to raise if they're in a good position. So I'm optimistic. I'm not going to give you a number, but I'm optimistic we should be able to see growth in 2026. Again, unless we see a decline at a global level, because we have seen for the past 5 years now, the continent follow global trends with a bit of a 6-month lag, sorry. So if we were to start seeing funding drop at a global level at the beginning of 2026, we should expect that drop to, if we see what happened in the past 5 years, to happen in Africa in the second half of 2026. So the questions we're currently hearing about an AI bubble and so on, we could burst, or where the growth rates could lower, that would eventually, if we believe what happened in the past 5 years, have an impact on funding on the continent as well.
Okay, thank you so much for your insights, Max. And now we'll move on to Ashim and Greg, that is right. We've seen investors that are putting large amounts of money into smaller number of startups. What are investors underwriting now that they weren't between 21 and 2022?
Please, Ashim, you want to answer that?
Sure, I'll give it a go, Grégoire, and I'm sure you'll add here. Samuel, I think it's a little bit more nuanced than that, most likely. So if we look at the report, it does indicate that geographies like Nigeria, for instance, still attracted quite significant volume in startup funding. So still a lot of companies, but smaller tickets. So supposedly indicating that it's a bit earlier stage that's still going in. And then, of course, you have some other geographies that attracted a few larger tickets, and a lot of them were, which I thought was interesting, as Max has said, sort of on the verge between VC and infra, especially when we talk about some of those climate tech deals, right, that really do have a significant sort of asset requirements on the balance sheet. So I think it's a little bit more of a nuanced conversation. And of course, we can't forget that as an ecosystem, we have also matured. So, we would expect that as we have, more later stage deals, growth stage deals, those are fewer deals still because we are still a maturing ecosystem. But of course, those would attract larger tickets. Also, of course, we know that, coming off the 2021, 2022 years, investors have become a little bit more discerning with regards to what they look for, what type of startups they're funding, what are the metrics that they'd like to sort of have ticked off prior to going in. So there was certainly a lot of, hype and, in those 2021 sort of post-COVID years. That certainly, bubbled away in 2023, 2024. We also had some macroeconomical challenges in some of our key markets. If you think about Nigeria, Egypt, Kenya, really, in those years, that has all sort of evened out a little bit in 2025. So lots of nuance, I think, in the funding data that we see, but definitely optimistic indicators.
Okay, thank you so much. Craig?
Just to add, nothing I don't have much to add on that, but which I think it's interesting to see this year, but again, thanks to the data provided by Africa's a Big Deal and Partech and so on. So I'm just commenting what I read and what I saw on the ground. The fact that there is a rebalance on the markets. Fintech is less dominant, and there is new sectors coming, health tech, climate tech, and the other one. So this is a clear sign of a market which is maturing. The fact that debt is higher only means that the unit economics of startups are much better than before. So those are good signs of maturity. And on my case, and I already shared some comment on that via Africa's a Big Deal, is the fact that we see a decrease of the pre-seed and seed deals, which is a concern for the future, because if we see investors having dry powder to deploy on good startups, and in the same time a pipeline of new startup coming to the market which is decreasing, it raised some concerns for the coming years. But that's, I would say, my biggest issue regarding the prediction.
Thank you so much. I think we are all in agreement that there's been funding is back on the continent and the ecosystem is benefiting. Um, Now to Laura and Olu, I just wanted to get a sense from you. Are we seeing a reset towards realistic growth and outcomes? What's your take on that?
Yeah, I'd say that in terms of has venture scale changed or how we view venture scale, is that very different? Honestly, I'd say yes. Venture scale, when VC started coming to Africa, everyone or most VC funds were emphasizing on $100 million in revenue for $1 billion valuation. I think this downturn or this reset, as I prefer to look at it, has just made us very honest or made us more honest about what venture scale actually means for us on the continent, given the nuances of the market. I think that we've redefined from a position of growing at any cost or growing or blitz scaling to more credible growth, given constrained capital. So we're focused more on sustainable growth rates, focused more on operational durability, strong unit economics for the startups. But yeah, that's how I see it. So less on how fast you're growing, but how you're growing, how well you're growing, and how you're getting there.
Yeah, I would agree with that. Unfortunately, not a lot of I don't think many would disagree with that. As capital has been constrained, I think we see startups trying to be a lot more efficient with their growth plans and have a credible path to profitability that investors can buy. And so, yeah, I think investors do really care about, I think the models we see from other parts of the world just don't necessarily work in the sort of funding environment that we see on the continent. And so investors who are in Africa are looking at unit economics, want to know, can and sometimes like stomach the, the initial growth and so on, but want to know and don't have as much grace for that to be far out into the future. I think also investors are really interested in sort of the regional defensibility and regional growth plans as well, because of the risk of one country. And then I think on the outcomes piece, yes, we all still like all the stories of the impact and so on, and but generally seeing, I think capital is becoming more and more commercial, more and more really focused on the financial feasibility and scalability of what we're investing in. Yeah, back to you, Samuel.
Thank you so much. Now let's move on to one area I think that's of interest to many of us, and we've seen its growth, which is the fintech. I think within the startup scene on the continent, fintech still remains number one, but now it is changing. It's no longer fintech at all costs. What is the new fintech that's get funded in 2026? This is to all of you, or is to the panel. Olu, you wanna go first?
I think Greg was going to go. I'll go after Greg.
Okay.
No, but I think the easy answer, I think, is to just recognize that AI is a strong hype and strong trend. So what we see on the continent is applied AI to any type of business. So it could be agri-tech, logistics, fintech. So I'm not sure we'll see, and it wouldn't make sense to see a sector which would be called AI, but definitely on the this is what we see now. It's the fact that the new business coming and the one which scales are the one who are applying AI to the sector that were gathering funds before. And yeah, could be my answer on my side.
Yeah, absolutely. And fully aligned with Greg on that. The way we see it, AI is more of a foundational layer of things. So definitely if you're using AI for your business, that's fantastic for many different reasons. But I think just looking more critically at sectors aside fintech, fintech is here to stay. There's still so much. We've only scratched the surface. There's still so much to do with that sector. But I also think that, when you look at sectors like energy, 43%, I think just over 40% of Africans still lack access to electricity. So there's a huge market there. About 1.5 over, I think 800, sorry, the stats are a bit fuzzy in my head now, but over 800,000 people or 1.5 billion people still lack access to emergency healthcare when you look at health tech. So when you just look at those sort of stats, it lets you know the size and the scale of problems that still need to be solved with certain sectors. Definitely agree with what Greg said about AI, but I think of AI more as a foundational layer, but just on a sectoral, from a sector basis or from a sectoral basis, I think energy, I think healthcare, even though the margins are really small, and in my conversations with investors, they tend to run a bit from healthcare, and of course fintech, because we've only scratched the surface there.
I'll jump in. I want to hear also what Max and others want to say, but I think on this question of fintechs remain number one, but it's not always fintechs. I would add a piece of like one thing that we see, and I start to hear from other investors, and it is not maybe something that all startup founders want to hear, but because much of Africa is so capital constrained, I have a growing belief that whether founders like it or not, they're going to have to become fintech aligned or fintechs themselves, or offer financial services if they're going to scale. So that's what we see the trend coming. And so I think for any early founders on the call, it's something really to be thinking about as far as like the assets and so on that you're working with, or the data that you're collecting, because all of that becomes monetizable, whether you become a fintech yourself or you align with other fintechs to provide financial services. If you have a sticky product, in order to really scale and scale regionally, that's what I'm seeing.
Yeah, and I will completely agree with that. I think it's people think about this when they think about AI. They like if you want to build a service today, you have to be AI aligned, leverage AI, and so on. But I would agree with your statement on fintech as well. I think that what we see sometimes is that when people hear fintech, they think about the fintech wave that started maybe 10-ish years ago, those large infrastructure fintechs that were basically competing with traditional banks or with mobile money providers. I think the fintech we're talking about today is the fintech that will unlock opportunities or create resilience, whether it's helping a household manage their budget, or bringing climate insurance to smallholder farmers, or allowing a family to afford an extra smartphone or a solar kit or whatever it is. And here I completely agree with you. What we've seen, and again, I'm talking more here from my experience at GSMA rather than my experience at Africa, the big deal is that in a lot of fields, including if you look at agriculture, for instance, we went from 15 years ago, startups and players just saying, farmers need data. But then it moved 10 to 5 years ago to startups need advice. But what is the advice if you don't? And that's when you start having to integrate fintech, is what is this advice if you don't have the financial means to allow you to invest in that new tool, or to buy that insurance, or to buy that insurance. So basically, and in a lot of sectors, we're seeing the need to integrate the financial element into the offering, because the insights or the advice itself has no value if you don't empower people to apply those.
Ashim?
I mean, I think the previous speakers have sort of, said most of it. That intersection is really what we will continue to see much more of. The embedded finance layers in whatever you're really building, whether it's in the agricultural space, in the healthcare space, in logistics. Just like Grégoire has said, where where we see that AI integration and that you've got to be an AI sort of enabled or something, having the intersection with some sort of a finance integration is going to be key. And a lot of what is being financed, interestingly, I think is going to start being a little bit sector agnostic almost, because it will be very difficult to define what sector it falls into. So just because you are financing climate specific essentials, does that make you a climate tech or a fintech, right? Because you are now enabling farmers to access a bigger marketplace and you're connecting them with logistics providers, what are you? Are you a marketplace? Are you a supply chain, platform? So I think we're going to see a lot more of that. And it's not unusual, because if you think about Africa and our multitude of challenges, they do breed these great opportunities where we have to think outside the box a little bit, It's part of the reason why a lot of our startups are not as asset light as in Silicon Valley, for instance, because the infrastructure is simply not always there. So, it's the same thing where we have to say, okay, well, I love the example that Max gave, with regards to the farmers, there is that evolution of the thinking with regards to how do we, in the most useful way, provide value to the end user, the end consumer of whatever product that we're trying to solve for. So, I think it's an exciting few years that we have ahead of us. And, maybe we just need to redefine how we look at sectors and how we, measure these kind of metrics, and maybe we have our own sort of metrics for that on the continent.
Thank you so much, all of you, for your comments. As we move on, environmental sustainability has become very topical at the moment, and it's also pushing new startups to come up. Laura, looking at the rise of climate and energy startups, what do you think is driving it? Policy, customer pool, blended finance, carbon markets, infrastructure gaps?
Well, I would sum what's driving it. I don't think it's any secret that institutional capital and the interest in these sectors is pretty plentiful. And so I think, like it or not, I see that as a big driver of it. Of course, there are great innovations and so on that are rising up in different markets on the continent, and that's really exciting to see. I see this as like actually a space where some of the secondary markets on the continent also. Kenya, of course, is an extremely interesting case as part of the Big Four. But I see that some of the secondary markets have an opportunity because of all that institutional capital that's interested in this space, and really driving that as a strategy, and that will have long-term impact on the entire economy if they can drive their innovation space aligned with kind of global institutional capital that's super interested in climate, energy, and even real economy. I think there's just such an understanding at the moment about the jobs that we need to create on the continent, and actually, as we look at startups need less and less as far as jobs in-house. Of course, the output from them in jobs and impacting their customers is huge, and that's where, but it's secondary and tertiary for startups. So I think, yeah, but the main point is institutional capital is probably the biggest driver here.
Okay. Just as a follow-up, looking at the subsectors within the climate space, which ones are overhyped and that are genuinely scalable?
I won't pretend to be an expert here. We do have some climate in our portfolio. So if others want to jump in here, I think, I'm most excited about ones that are pretty practical on the continent. So we've invested in like an EV company, Rome, in Kenya and some things like that. I do not pretend to be a carbon offtake and all that expert. We have done a few in that space, Octavia in particular in Kenya, but if anyone else wants to jump in and talk about that, it's not something. I'm much more interested in at the moment in kind of the opportunity that many startups are creating on the fintech side, because I think at the end of the day, to impact Africa, we really have to continue working and enable startups to work on the lack of credit in so many markets. And so that's where I focus, but love to hear other experts on the call. Anyone?
Okay. Just a follow-up as well, probably the last one on this one. Are you guys eyeing any investments within the climate tech?
We would consider, but we're aligning with this piece where we want to see kind of that there is going to be the potential for them to scale by aligning with or becoming a fintech themselves, because I think this will be a bridge for our space. VC in itself and our capacity to raise is going to be and to continue raising funds on the continent is going to be dependent on exits, on mergers and acquisitions, and so on, and that is not happening fast enough. So investors are looking for ways to get returns faster, and so on. And so I think this piece that is in the report about the growth of debt, that's a trend we're going to continue to see VC take in order to get that in the interim as we wait for markets really to come together and be efficient.
Thanks, Laura, for your insights. Ashim, coming to you now. Venture debt has reached some historic levels, and some periods have rivaled, exceeded equity. What does that signal? Maturity or risk transfer?
I'd say probably a bit of both, but certainly maturity in the ecosystem as well. You know, as companies mature, and especially if you think about where that debt has gone, it's primarily gone into fintechs and I suppose climate techs. And then if you think about, okay, well, what is their business model? What do they require, financing for? For the fintechs, a lot of that is required for unlending. A lot of there's a lot of microcredits. There's a lot of, sort of end user lending happening, and as well as B2B lending, right, into smaller than micro and small business holders. And on the climate space, of course, you've got a lot of big purchases that need to be done, infrastructural or other assets. And then again, you do have some on-lending happening as well, whether that is then to solar installers, for instance, and that kind of stuff. So there is a lot of maturity that we see because some of this debt has gone into, much more mature companies that are, sort of in the Series A, Series B, B plus space. So those ticket sizes are actually quite large as well. I think also, and this is probably maybe a third nuance or a third, sort of reason why debt has really increased in relevance. And this is to do with investors also realizing that debt can be an accelerator to growth. So oftentimes, especially in the early stages, and I'm saying here seed stage to Series A stage, we've oftentimes tried to solve that growth, the J curve that we're all looking for, by just equity. But oftentimes you actually can't deploy that quick enough. It is obviously also a more expensive instrument, and the returns that you're looking for equity can oftentimes not be sustained for such quick growth. So debt can actually help equity investors accelerate that growth, right? So we sit on both sides of that coin. We do both equity and debt, and we do that for our own portfolio companies as well as outside the portfolio as well. So we really do believe that it accelerates that growth that we'd like to see, because startups can actually much quicker try and run and do and roll over and just ensure that they're really driving the growth, driving the revenues that we've all got to see in the end of the day. So we're hoping that the growth of debt is going to actually accelerate more exits also over time, more sort of M&As. And I see Zivago is saying he doesn't agree or she doesn't agree, and that's perfectly fine. This is sort of what we see firsthand as equity and debt investors. So yes, it's a great space to play in at the moment.
And what must founders have in place for them to responsibly use debt?
Yeah, that's a great question. Debt requires a different type of discipline, not an additional type of discipline, just a different type. Reporting on debt can be very different than on equity. You have to think that the instruments typically are much more short term. There can be debt that is as short as a 90-day, sort of loan. A venture debt typically is a little bit longer. We can sort of look the 18, 24 months, but it is a much shorter cycle than if you have an equity investor sitting, with you for 5, 7, 9, 15 years, and you're sort of building the business together. So there is reporting requirements that you've got to really, be sort of on top of. You've got to ensure that even as you think about wanting to take on debt, you really have to think about, ensuring that you've got your financials tidied up. You've got your management accounts in place. You've got, your sort of last year's financials audited. There's a number of sort of those elements that debt investors want to see so that they can then actually look at the ratios and say, hey.
Hello, are you there?
I think we lost Hashim.
Oh, okay.
To report back properly.
We lost you some seconds, Hashim.
You lost me for a moment. Sorry about that.
Yeah.
I'm not sure at what point, but I guess the message has come across anyway. All
right, no, that's fine. Thank you for your insights. And now we'll move on to Max and Olu. We're looking at AI. It took a major share of the deal activity. Is AI a sector or a layer? Where is AI actually producing defensible businesses in Africa today?
Yeah, I think that I touched on this earlier when I was speaking. AI is definitely a layer. That's how I see it. I believe that's how most people see it. It's not a standalone sector. I think that AI just helps you do things faster, specifically with startups. It's helping startups reduce costs, increase conversion, maximize or help their risk outcomes as well. In terms of where we're seeing people or where we're seeing defensible businesses in Africa use AI. So in fintech, it's stuff like payments ops, fraud, managing credit risk, helping with customer support, collections. In agri-tech, it's soil testing. We recently supported a startup in just based out of Kenya, doing some detection in the soil, they take samples from the soil and then they use it to sort of predict what sort of pests to expect at a certain point in time, and they're using AI to do that. So those are some of the ways that we're seeing defensible businesses in Africa use AI. I personally view AI as a foundational layer, not a vertical sector. I think that the defensibility comes from proprietary, localized data sets. So just ensuring that you're using your own local data, you're collecting your data, which to be honest is a lot of work. And not to be overlooked as something that is easy. It requires work, but I think that's where the core defensibility for using AI is. Max, over to you.
No, I completely agree with you. For me, AI is like a tool layer. It's not AI for the sake of AI. And what I'm particularly interested in beyond how to use AI to improve like business processes and so on, be more efficient, is applied AI or small AI, if I can say, context specific AI. Like a few years ago, people were just saying like, oh, you can't do any AI in Africa because you don't have enough data, or the data isn't clean enough and so on. Turns out, if you ask ChatGPT what to plant in rural Kaduna, there are very good chances that the results you're going to get from ChatGPT are going to be very bad. But if you ask a small language model where you feed data from local agri-techs, from the Ministry of Agriculture, like context-specific data, you'll actually be surprised by the quality of the results that you're going to get. So I think we've gone very quickly. African entrepreneurs have gone past the hype of AI into like what can be deployed that will actually make sense for the businesses and for the end users. And I'm glad we went there very quickly.
Thanks, Max. But I'll continue with you still. Looking at Southern Africa, it did capture a significant capital share with fewer deals. What's behind this concentration? Is it later stage assets, deeper capital markets, stronger governance, managers and acquisition readiness? Which is which?
Again, elements of all of it. I would just say we're not talking about Southern Africa here. We're really talking about South Africa. If you look at Africa, if you divide Africa in 5 sub-regions according to what the African Union does, like in Southern Africa, 99% of the funding, according to our numbers, went to South Africa specifically. And in South Africa, it's the only big 4 market that in 2025 saw year-on-year growth in terms of total funding raised by startups, in terms of total equity raised, specifically in terms of the number of deals. It's also one of the only 2 markets where you had an IPO, a startup IPO in 2025. So I think all these elements point to breadth and depth in the market, and like the spectrum of tools and vehicles and investors available to startups is much wider. And also, I mean, the reality is that the large deals of today are smaller deals of a couple years ago, and even smaller deals of like 4, 5, 6 years ago. So it's also like South Africa is riding a wave of like 10 years of investment, and like people who have done very early stage investment before the 2020s. And that's, in my opinion, what really puts it at a level of maturity that is ahead of its peers.
Okay. No, thank you. Now back to Laura and Ashim. I think there's been a lot of cross-border scaling within the startup scene. How should founders think about cross-border scaling, and what's the modern playbook that they can use to achieve that?
I'll jump in. I'm not sure there's a playbook for every startup. I wish there was, because I think the opportunity, the Pan-Africa, the Africa opportunity is it's at the heart of what makes what we're all working on so exciting and so challenging, and just much more for those founders that are trying to be efficient with their capital. And I think what I've seen is on every cap table is the investor who thinks that the startup should go fast to the region because of one country risk, and the investor who thinks they should go deep and not stick their toe in additional markets. I probably, just because of my own experiences and what I've seen in startups we've invested in, am a little bit more towards skewed of the regional expansion and so on is really critical to understand and be planning for. And in fact, I love a founder who says, that they're from day one planning for their second market. But it has to be in a realistic way. And sometimes, so how you pitch that to your investor, I think, has to be really credible in order to get the capital to do it. So I don't think that there is necessarily a playbook on it. I think it is really dependent on the model and what's going, what the factors of that are. I think it's a very complicated thing, but I also see for founders and startups that get it right. It is the path that one has to take to create something of value that will be acquired or that will make it the whole way. And so I definitely worth spending a lot of time on that whole piece. Ashim?
I agree, Laura. I don't believe that there is a playbook that we can blindly follow. Scaling, expansion or growth, has many different forms, and Africa is 54 markets, and then there's plenty other markets out there in the world still that one can consider. Sometimes you scale and you go immediately outside of Africa. Even we've seen that with one or two companies. So it's not always I am in Senegal, and therefore I need to go conquer my adjacent francophone markets. It doesn't always work like that. Or I am in Kenya, and therefore I need to come to Nigeria so that I can showcase that I'm a Pan-African winner. It does need to be very deliberate. There has to be quite a lot of research, market knowledge, or market knowledge acquisition done, and that can be done, in many different ways, by obviously sort of collaborating with local champions within the countries, with your investors that you have, leveraging their data, their networks. But it's really key to not assume that because this is a market that looks similar, that your product or your solution will in fact be successful. It might in fact not be at all. So it's really key to not just go by sort of, okay, I see the GDP data and I think this, is a good market for me to go in, or I see that here's another 100 million people for me to conquer. You've got to really understand whether or not that is the right market for you, and whether or not you should even be expanding at this point or not.
Thank you so much.
I'll just add on to that. I think this is somewhere where I've had to change my mind. Like a couple of years ago, I would say, well, the African market is big enough. Why would you go global? But I think we have some interesting cases now of African startups going global, and that's how they get to scale. And also of global startups like Zipline, and there's a couple others who actually couldn't get to commercial scale because of regulations and so on in their home market, came to Africa and perfected a product and then went back to their home country. So I think we're going to see more and more of that. And I've definitely had to change my mind about because Africa is big enough. But in some cases, I think it does make sense for people to go to MENA, go to Europe, and so on. But with eyes wide open.
I would just maybe add, if you don't mind, Samuel, just add one point to that. I completely agree. And if I'm trying to think what could convince a Nigerian startup tomorrow who's looking at replicating to go to Kenya or to South Africa, as opposed to looking towards Indonesia or Brazil and so on, my opinion is some level of harmonization of policies and regulations and how to move people, how to move goods, free trade, and so on. It's the reality, and still resonates with me. 3 years ago, I had a conversation with a founder of a credit startup in Nigeria, and I was like, okay, so which market is next? Like, are you doing Ghana? Are you going to try Kenya? And he just said, like, no, if we're going to have to go through the trouble of registering a company, understanding the regulation and so on, we're going to try and go for Brazil or India or Indonesia, like a very large market. We're not going to put that energy towards a Ghana, because when you've perfected your product in Nigeria, well, you might have a product that could be translated into the Guinean market easily, but understanding the regulation, how to set up a business and so on, your taxes, it's the same amount of work for Ghana that it is for Brazil.
Do you think that the regulators understand that they're hindering success of these startups with the different regulatory regimes?
They talk about it. Is it progressing in the right direction? Are they ready to give up their power and sovereignty and so on to really move the needle? I've not seen that a lot, unfortunately. Not as much as I think the ecosystem requires.
And as ecosystem builders, what are you guys doing around that, if any?
Just Samuel, before you go to that next question, just coming back to the playbook, what we saw on during the winter we experienced the 2 last years is the fact that more startups were considering small M&A, leveraging their capacity to raise funds in their country, to acquire small startups in other countries, to speed up the process and just not to have all the burden of learning everything from day one. So this is something which was not a very, there were not so much data on that, but very significant operation everywhere on the continent. And second point is, well, we are talking about Africa as a whole region, but North Africa, for instance, from day one, have startups which sell the operation to Europe, for instance, and that's very common. And again, the biggest exit of the continent from Tunisia is exactly that story. Startups out of Tunisia, out of Morocco, selling their solution to Europe or to bigger markets. And we see that more and more, especially in the context where there was some forex pressure on the continent. So that pushed more startups to find markets with hard currencies.
Thank you, Greg. Max, ask a question. Do you want to jump in?
Yeah, I don't know exactly where the incentives lay. I think there's a disconnect between the time frames of what a politician and a regulator looks like and what the ecosystem looks like. Like I was just mentioning Tunisia. I was in Tunisia not so long after the InstaDeep acquisition and so on, and I was very surprised by how a lot of people I was talking to actually sounded a little bit deflated and were saying like, yes, it is a great story. Everybody's talking about that, but they had set up most of their team in London and they sold outside of the continent and so on. And I just like, my reaction was like, you're looking at it really short term, like, because they were also saying we've invested a lot in a lot of those engineers in Tunisia and so on. And actually like the talent and the money leaves the country. And I was like, short term, it is true. But if you look at midterm or long term, like, are these people going to be coming back or investing back in the country, promoting the country? Yes, they are. But for when you're trying to build an ecosystem or you're trying to stay in power as a politician, you're looking really short term, best case scenario, medium term. And you're not looking at like, what is your long-term plan, basically, of just thinking like, it is frustrating, but the way, I mean, unless you're in Nigeria and you have a very long story of a diaspora, large numbers and so on, you're already seeing that phenomenon of people coming back. If your country is with smaller diaspora or you're still at an earlier stage, it can be frustrating. And I think in some cases it creates an incentive to focus on things that are maybe a little bit smaller scale and will have less long-term impact, as opposed to just creating a system that allows replication, that allows like talent and capital to leave your market to come back at a later stage.
Thanks so much, Max, for your insights. As we move towards the end of our program, let's now look at exits and liquidity. I'll start with you, Max. IPOs are back after so many years. How should we interpret that? Sign of maturity, exceptional cases? What is it? The IPOs.
I mean, we're running out of time, so I'll be very quick. It's a good signal, definitely, after 5 or 6 years with our startup IPO. It's far from being a wave of IPOs. It's 2 IPOs in a quarter, which is really good. But I think in a context where if we assume there are nine unicorns in Africa today, on the continent, none of them seem to be really actively considering an IPO. I think it's a good sign to just remind people that to get an IPO, you don't need a unicorn. You have startups with less revenue, less valuation. That's also a pattern and an avenue for them to grow. So it's a good reminder that it's possible, and that capital markets are an option to finance yourself if you've reached a certain size and certain type of business. And that you also, I think another very important point is that it's a reminder that you can list on the continent. You do not have to go to New York City or to go to London to list. You can list on the continent, because both of those IPOs happened in Africa.
Okay, no, thanks. And Olu, what role can corporates play in accelerating liquidity pathways?
Yeah, absolutely. Fantastic question. I think that the first thing is, and I'll try to be super honest, is stop acting like they're experimenting and actually dip their feet in the water as opposed to having their toes in it. I mean, revenue partnerships is one way, and revenue partnerships will always be fantastic. But I think the other thing is just sort of having clear paths to acquisition and being very straightforward with that. And ironically, the people or the institutions that do this quite well. When you think about Flutterwave, you think about Moneypoint, who obviously started as, and it's probably because they started, some people still refer to Flutterwave and Moneypoint as startups, but they're unicorns, so I don't think they're startups anymore. But I think the reason why they do this very well is because they've walked the talk. They understand what it means to be in the ecosystem. They understand what it means to operate on the continent, etc. If you zoom in even closer to someone like GB, the founder of Flutterwave, who they recently acquired Mono, but that started off as a pilot running a test with Flutterwave. Eventually GB did allegedly invest in Mono, and they very recently acquired them. That didn't and if you also look at Moneypoint, it's quite similar with some of the acquisitions they've done. So I think corporates, the bigger folks, the large corporates, the banks, etc., are just sort of also taking that approach. It's much cheaper to buy innovation than to build it internally. So I think that's one way. And I think the final thing is just access to distribution, data, infrastructure. Of course, that takes longer. Or some startups are scrappy, so they'd have to make certain changes internally, but regardless of whether or not they end up with the access to data, the distribution infrastructure, I think it's still a process that is worth it. So revenue partnerships are fantastic, but I'd say definitely having a clear path to acquisition of sorts, and of course giving access to distribution, data, infrastructure, just putting their head in the game as opposed to experimenting and one leg in, one leg out.
Okay, thank you.
Okay, so
Now
so we have to stop here. Yeah, we have to move to the Q&A because I know the conversation is so great. I don't even want to stop here, but we have to move to Q&A. I think most of the points were really greatly covered. And I know our panelists have a hard stop. So I will go to there's one question that is in the chat that I'm just going to drop as the very first, and then we're going to engage with the audience, see if they have other questions. But it's I see from Terence. He's asking, my question is on data sovereignty. Since most stars are eventually controlled and owned by foreign VCs, the tech stack we are building on is also not ours. How do we go around this problem? Well, what's your take around this?
I'll jump in very quickly. I think that's a really valid and important point that Lawrence raised. Data sovereignty overall is something that African regulators and governments are looking much more into. Ownership conversations flow into that, but that's not where it stops, right? I mean, there are some countries or jurisdictions, Rwanda comes to mind, where data localization is very key, and ensuring that data is kept on local servers and not on foreign servers, things like that. So there are ways that the regulators or the governments can sort of play here. But of course, ownership and where funding comes from plays a big role with regards to the overall ownership of the tech stack, maybe. But whether or not that is then the data ownership, I think is sometimes not the same question or conversation.
Right. Any other take? Or maybe Gregoire?
It's everywhere the case. Look at Mistral, for instance, a French AI startup. It's not owned by French. It's owned by US VC, some corporate from the Netherlands. This is how it works. The question is, who controls the company, which makes that company a Kenyan startup? The fact that the fact that the founders are from Kenya, the fact that the teams are from Kenya, the fact that the headquarters is in Kenya makes this startup a Kenyan one. I don't know if it's a valid debate to have, because it's at the end what you want to have is impact on the ground. So take the cash where there is some cash, and today the cash is coming from other continents, but it will have an impact in your country, and you control the startups, and make sure that you control your startup on over the process of fundraising. So do not dilute too much at the very beginning, and then keep that VCs want to invest into startups where the founders control the startup. So I think this debate is everywhere, but just remember that the impact is on you, on the ground, and on your country.
Yeah, 100%. Then I'm going to take a second one. That might be our last, but for the African startups who mature and reach exit or M&A stages, how do you think about structuring those outcomes so that value creation continues to compound locally in terms of ownership, talent, and reinvestment, while still delivering strong returns to global investors? That's the question. Like that, don't know who wants to try to take that in terms of creating continuous value.
We have a small comment on that. Just we mentioned in Steadip and that story, that what happened the day after, and I think Christophe mentioned that at the introduction, is the fact that Karim reinvested his cash on startup out of Tunisia and Morocco and North Africa. So the impact is huge, because once you have a real business angel investing his own money and his own network to support entrepreneurs, you have a positive, a virtuous circle of impact on the ground. So this is, I think, what we try and why, and when we are VCs trying to, and our mission at Digital Africa is to make sure that we see more success in countries beyond the Big Four. This is exactly what we're trying to achieve, is to make sure that we see more startups going from seed to Series A and then to exit to reinvest in their local ecosystem.
And maybe something I would add to this is that you need to trust the early stage investors and the entrepreneurs and so on to do that, to reinvest in the ecosystem and so on. I think there could be a tendency, and for me that would be a risk, to try and start putting rules and just saying you set up a startup in my country as a regulator, but if you decide to sell, there's like starting putting too much structure and too much rules around what you'll be able to do with the money when there's an exit and so on, which could at the end of the day deter the best investors and the best investors and the best startups from investing and setting their company in your market. I think you need to trust the ecosystem a little bit.
100%. And thank you, Max. And thank you, everyone. This is going to be the end. I know there are more questions. We're going to take them. We're going to share it to you on our speaker groups that afterwards we see how to respond to that even online. But thank you once again, Ashim, Laura, Samuel, for the great moderation, Max, Gregoire, Oluwaduni, for your insight, for your time. This was a great panel. I really learned a lot myself. and excited to see you also very soon alongside our tour. And this is the end, everyone. Thank you so much for joining. Thank you for our attendees. The report is out, so we're gonna drop the link now in the chat, and you're welcome to download it. You're welcome to read it during the weekend, next week. We're gonna share it on all our platforms, and you're gonna be able to dive more into the insight that the speakers have spoken about. And thank you so much again for the conversation. And just as a last announcement, to finish on a high, AfricArena Kinshasa Summit is coming on the 4th of March. For those who will be around the region, join us. If you want to have more information, contact us. Same for Nairobi. We are coming 29th, 30th of April. We'll be excited to see you in the audience. So thank you so much, everyone. I'm gonna take the question now. The link should be in the chat. I'm gonna drop it now, and see you very soon, everyone. Thank you so much for joining. Thank you.
Thank you.
Bye-bye.